Thank you all for joining us today for the second part of our pandemic webinar series as we discuss the effects of COVID-19 on private capital. My name is Keith Crouch and I'm an Associate Director of Product Management here at Burgiss, where I focus on the Burgiss Manager universe. For those who are less familiar with us, Burgiss is a leading provider of analytics and data solutions for global investors of private capital. And within those solutions, the Burgiss Manager Universe is our research quality database, which includes the complete transactional history for over 10,000 private capital funds. This is the data set powering today's discussion. Now, we are joined today by Tim Jenkinson and Luis O'Shea. For those who don't know Tim, let me provide a quick background on him. He is a professor of finance at the Said Business School at the University of Oxford, and he's considered one of the leading authorities on private equity, IPOs, and institutional asset management. He also serves as director of the Oxford Private Equity Institute and is one of the founders of the Private Equity Research Consortium. He's a professorial fellow at Keble College, University of Oxford, and a research associate of the European Corporate Governance Institute. Thank you for joining us today, Tim. And for those who don't know Luis, a quick background on him. He is head of the applied research team here at Burgiss and has over 15 years of experience in quantitative research and financial modeling. Now, Luis started his career at McKinsey in Madrid, and he's also been a director at BlackRock, a director at Axioma, and had headed the US research group at RiskMetrics. Luis holds a PhD in mathematics from Cornell University. And so thank you for joining us today as well, Luis. Now, we're going to spend the next hour discussing Q1 and Q2 returns and how they compare to public markets. We're also going to take a deeper look at capital calls and distributions during the last two quarters. And then we're going to look at the dispersion of returns and how a fund's Q1 returns might have been correlated with its Q2 returns. But we will, of course, cover any other topics which come up, because we are hoping to hear a lot of questions from the audience today. But first, we are going to hear some prepared comments from both Tim and Luis, and then we'll have our Q&A session at the end. So with all that said, let me hand it over to Tim.
Great, thanks very much, Keith, and it's good to be back on the second one of these Burgiss webinars. I hope some of you may have been on the previous one, which we held at the end of Q1. And if you were, you know I did the very rash thing of making some predictions about what Q2 might look like. And so today I'll reveal whether those predictions were right or not. So that's really the plan of today's session. Last time we called it the Corona Quarter. This time we're going to call it the Corona Bounce, but there is a question mark after that bounce. As we know, sometimes bounces can be very elastic, and sometimes they can be not very bouncy. It's the so-called dead cat bounce. And so we'll see what Q2 really looked like for the Corona crisis. So the plan for today is going to have some similarity to what we actually discussed last time, but there's some interesting new dimensions, I think, some of the picture gets filled in as time goes on. And so we're going to focus a bit on those Q2 numbers, how they look over the last sort of 3 quarters. We're going to look at the quarterly returns, but at the asset classes as a whole. We'll look at IRRs and multiples, and then PMEs and how the returns have been moving relative to the markets, which we know at the end of Q1, markets have started recovering but haven't, maybe recovered fully. So we're going to see what happens now that we know markets have actually recovered in many sectors considerably over the last 6 months. And then we're going to have a little look at US versus Europe. And then I'll finish off by looking at the cash flows and distributions. So that's really the plan for this session. And as Keith said, please do throw in any questions that you want along the route, and Keith will keep an eye on them. In terms of the sort of the big picture, if you start by looking at what I put up here is the Q1 2020 figures, which were the quarterly figures from the end of 2019 to the start of 2020. They're there on the right. And the Q2 2020 figures. Now, there's one thing I just wanted to say, up front, which is an inevitable feature of these updates is these are very quick updates after the end of the Q2, and many funds don't actually report completely on time, and so therefore some of the data will only get actually updated a bit later on as the weeks or months go ahead. So these are that's why the Q2 2020 figures say underneath them preliminary, because not all the funds will have reported. Having said that, these are the results for the funds that have reported, and that's relevant for that'll be more relevant when I show you the fund level returns, because some of those aren't fully updated yet. So they're not quite the final numbers, and so but these give a good sense of the quarter-on-quarter returns, which there's been. And I think it's really striking when you look at this. If you look at the highest possible level, so global all private capital, which went down 8.3 in Q1, that was followed by an 8.1 gain in Q2, which is a pretty healthy bounce, I would say. And indeed, if you look at it just on the US, so you don't have any sorts of currency issues built in there at all, you've got a more or less equal and opposite positive return relative to the negative return in Q1. Now, if you dig down a little bit deeper into that and look at some of the various asset classes, you see some interesting stories there as well. On the buyout side, you see that US buyout returns are again pretty much bounced back, a bit less so in Europe, and so, but obviously these are actually in dollar returns. So there's also an exchange rate effect coming in here as well, because the euro has been quite strong relative to the dollar over this quarter. But again, you see a reasonable bounce back, pretty much a full bounce back virtually on the buyout side. Obviously, you're going down from a higher figure and then taking a return up from a lower figure, so it's not a complete bounce back in percentage terms. I think one of the really fascinating things here is venture capital, where the initial markdowns were not that great, and the bounce back has been pretty significant, much considerable. Now again, there's a few issues here. These are the sort of pooled type returns which you get, which take account of fund size. So it could be here that this reflects the bigger funds doing particularly well over this quarter, and they may have particular types of investments like tech investments which have done very well. And what I'm going to show you later are fund level returns which are medians. So it sort of strips out some of those effects. So these are some of the things to bear in mind, but again, really significant bounce back on the equity side. In terms of debt, we also see a bounce, but maybe a bit less, as you might expect, given the nature of this pandemic and the fact that a lot of the debt is probably quite challenged in some of these sectors like retail and property and the like. But there has been a modest bounce back on the debt side, and on real assets, well, not entirely. As you might expect, real estate hasn't really bounced at all, and indeed, as in some jurisdictions, has continued to be marked down. So that has not benefited from the general upward movement in markets. A bit of a bounce back in natural resources, in particular energy, but that had the biggest fall, down 23% Q1 and up 4% in Q2. So still way down. But that, I think, is a very nice sort of overarching view of the way that the markets have bounced. There is a bounce in most of the asset classes, but not much on the real estate and natural resource side. So that gives us sort of a quarterly review of those pooled returns. If we go to look at it through a slightly different lens, and these are the These are the fund level returns, looking at the median fund globally. And so what this will do is it will obviously, given it's a median, it will miss out some of if there's some very high performers, especially if there's some high performers amongst the larger funds, then it won't show through so much in these medians. And indeed, an interesting topic maybe for a future webinar is the relationship between the median returns and the pooled returns, which we may take a closer look at, because I think they tell slightly different stories. But the way this chart is organized is the blue line at the top is the global median IRR on buyout funds before the crisis struck. So generally in the sort of 15% IRR mark for most of those vintage years. So this is done by vintage year of the fund. And then the red line is if you like, the effect of the corona quarter, where you can see a big dislocation between those lines. So generally IRRs falling by 2, 3, 4, up to 6 percentage points for some of the most recent vintages. And then the green line shows, if you like, the bounce back, which again, this is not the full story, because some of the funds here will not yet have revised upwards there or provided updated NAVs. And they are reflected in this data, whereas they weren't in the previous slide, where anyone who hadn't reported is not yet included in that. These do include all funds, whether they've updated or not. So my prediction that there would be this bounce was not a very clever prediction, but it is clearly true. We'll see also, I mainly made it about PMEs, which we'll come on to in a minute. But these returns have bounced. I would anticipate that they would bounce a bit more by the time the final Q2 figures are all in for the funds, because I think some of them are probably are slightly behind the times. They haven't yet updated, and so those will probably go up as well. So that's the IRR side. In terms of TVPIs, sort of money multiples, the effect on money multiples was a little bit less dramatic in terms of the effect. It was about a 0.1 maximum sort of effect that it had. And much of that has come back for many of those vintage years, where the green line now is pretty close for many of them to the pre-COVID effects, but still a little bit lower, which is sort of consistent with the early stage, the first couple of slides. So again, we see the sort of the money multiples. These tend to develop over time. So you see I would expect these later vintage years to gradually ease up as value is added onto the portfolio companies, which the most recent vintages, they haven't had long to actually have money invested. And that's what history tends to find, is that the money multiples go up over time. And in recent years, there's been a sort of rough rule of thumb, which is that you tend to end up with a net median TVPI of about 1.5, which is showing up here for the middle vintage years. But I think we probably expect that, or might expect that, to also be true for the later vintage years as time goes by. Then in terms of the PMEs, now here's where I predicted these you have to be a little bit careful about, because as we noted last time, the PMEs here, the charts are sort of inverted, that the pre-COVID PMEs were the blue line, which was, for some of these vintage years was just below 1, and others were a bit above 1. For the COVID quarter, the end of Q1, they jumped up, and that's the red line. And that's because we hypothesized that there wasn't a complete mark to market, that the funds had actually not marked down their investments as much as they might have done given the movement in markets. On the other hand, those PMEs then come back down in Q2 because markets went up, and yet the valuations didn't go up as much. And so this is, if you like, a clear evidence of smoothing happening, that the extent to which those those PME, the valuations of the funds sort of go up and down with markets, does tend to be a little bit attenuated by the funds. And so the net effect is that for most vintage years here, as you can see, all vintage years, they're either at or marginally above the PMEs that existed pre-COVID. And again, there might be a little bit of an uptick in that over the next few weeks, or by the time we report on the next quarter, because more of the funds will have actually reported their final Q2 figures. Okay, so that's interesting, and the prediction was right that I made at the end of the last one, that I would expect the Q2 to be in between the Q1 and the Q4 2019. So that's buyouts. If you look at venture capital, it's a slightly different story insofar as there was much less of an IRR effect. A little, decent on the most recent vintage years. We're reporting in 2017, but they're still very immature, and not much of an effect on the earlier vintage years. That could be because a lot of these funds have tech investments in there, which are actually, some of those have done very well and have not really been affected in the same way by the macro economy. And indeed, it makes one think a little bit about whether there are additional sort of risk factors that one should build into some of our risk models about, the things like pandemics. Some businesses are much more sort of robust to those than others. But there has been an uptick in those IRRs, and in all the vintages, they haven't quite got back to where they were before on a median fund basis, notwithstanding the fact that you'll notice on the first slide, the funds that have reported on a pooled basis, the actual bounce was larger than the loss. And that's, again, where I say there's an interesting relationship here between maybe the larger funds and the smaller funds. And the larger funds, the size of the fund or the like doesn't have any effect upon the median IRRs of the funds, but it does on the pooled numbers. And that's something which I say we might have a look at. TVPIs, much the same sort of story. In some of the vintage years, actually, the TVPIs are now higher in Q2 than they were before the COVID crisis struck. And so, but basically, they're sort of back more or less to where they were. In terms of PMEs, same sort of story as the in buyouts. Highest figures were for the Q1, where there wasn't much reaction to the market gains, and to some extent those have now come back in Q2, because as the market's gone up, then the returns, the valuations haven't gone up as much. And so, again, you're sort of sitting here with, at the end of the day, slightly higher PMEs. In fact, in some ways, some significantly higher PMEs. They've gone up by about 0.8 relative to, sorry, 0.08. 0.8 would be a good performance. 0.08 relative to the pre-crisis numbers. So some interesting effects there, I think, and sort of clear signals of that bounce. This is a slightly different way to look at it, because I think that you can also, what I want to do, those were global figures, and I think it's interesting to take a look at what's happening in the US versus Europe, because I know in the last big crisis, the global financial crisis, there was some talk that the funds behaved a little bit differently according to whether they were in US and Europe. And so what we've done here is split them out and look at the effects in the across the vintage years. And you'll see that there has been the way I look at that data is that there was perhaps a little bit more of an impact on the European funds, which might be expected, because maybe some of the European economies were much more affected by this early on. And so the shock here is, if you like, the Q1 shock. The red lines below the line are the effect on TVPIs, on money multiples, and then the green lines are the second quarter bounce, if you like. And again, you can see that, if you're looking at it by vintage year, there's been, a modest bounce in most of those vintage years, but in some it's still not really that noticeable. When you're looking at the median TVPI, again on the pooled basis, it can look a little bit different. The good thing about doing it this way is there's no foreign currency issues really. We're sort of stripping out any dollar effects in those which are there in those global numbers. And similarly, we can do the same for the PMEs. Here you have to look at the graphs, so they're sort of upside down, because if you remember, PMEs were actually positively impacted by Q1 because the markets went down, but the valuations didn't go down as much. So that's why we've put in inverted commas here the shock. It was a sort of positive shock, or it could be really smoothing that the PMEs went up in that first quarter, the red bars, and then they've come back quite a long way in the second quarter. So the bounce is here sort of downwards, if you like. If you can get a sense of that from a metaphysical sense of a negative bounce. But and you'll see there that in some ways I would interpret that as being that the US seems to have been a little bit more symmetric than Europe. Again, it might be that some of the European funds are a bit slower in reporting, so we don't quite know yet. These PMEs, by the way, are on the basis of the local fund returns. So the European is against the MSCI Europe, and the US are against the S&P 500. For the global figures, we use the S&P 500, which again, you have to choose some index, but here we can strip out the effect of any relative movement in the S&P, which has clearly been one of the top performing, probably the top performing index in the US, and certainly been stronger than many European indices. This is actually taking MSCI Europe for the European numbers. If we do the same with VC, you can see that the effects on European venture capital funds were somewhat greater. The way I look at this is that their markdowns were a bit more, and that might make sense because there isn't so much tech predominance in many of those funds, and the bounce has probably been a bit less as well in Europe than in the US. Whereas the US, the bounce and the effect seems pretty symmetric, except for a couple of the quarters where a couple of the vintage years where it actually seems to be positive. And in Europe, it's I'd say a little bit more muted than in the US in terms of the valuations. And again, with PMEs, we see a slightly bigger effect on the positive effect on the PMEs. So maybe there was a little bit less mark to market in the European market, and then perhaps a bit more response, sort of maybe it's just a delayed response in Q2. And so I think that gives an interesting look at them. I don't see a huge difference between those sorts of responses. If you're saying, oh yeah, there's more mark to market in Europe or the US, I don't see a huge difference there. But those are still, the Q2 figures are still a little bit preliminary because these figures do include funds which haven't yet updated their Q2 numbers. Okay, so that's the returns. In terms of the cash flows, we showed some of this data last year, but I thought it would be interesting to show it in a slightly different way this time. What we've done is show the last 2 years of cash flows to give you a sense of the cyclicality of the way that cash flows are generated month by month. And so the blue bars here are contributions into the fund, so they're capital calls, and the green bars are the distributions back from the funds. And I think this gives to me, this was a very interesting story because I don't think I had ever really fully understood the cyclical nature of this. I know there's only 2 years here, but they do give a sense that there's a lot of action happening in December each year, and then the typical flows here are currently about 25 to 30 billion on a monthly basis, both in and out actually, because the net cash flow has been pretty close to zero over much of this period. When you look at that graph, you can't help thinking that the March and April figures that I showed last time still do look a bit strange in terms of, you know, the cash contributions into the funds. Maybe less so than you might have, you know, when you look above into the 2019 numbers, maybe it's not huge. I'm not sure it would be statistically significant, but certainly there does seem to be, it wasn't the case that the funds weren't calling capital in the key March and April months. They were calling plenty of capital. And clearly the cash distributions over the last, over the most recent few months have not been so good. If you look at it over the first half, I worked out the numbers, and in fact, if you just look at the contributions in the first 6 months of this year, they were 139 billion for 2020 and 149 billion for the previous year. So they're actually, you know, overall there hasn't been more capital calls than there were last year. In fact, slightly lower. So, but the distributions are significantly lower. So there was 140, close to 144 billion returned in the first half of 2019, and now 113 billion. So, you know, it's about a 20 billion difference in the net contribution. So there's a net capital inflow, which is $20 billion more than last year. Now, having said that, there's a heck of a lot of dry powder, so it may be what we expect, but that's the sort of way that the cash flows are looking. That looks like March and April were, to some extent, a slight, a bit unusual, but maybe not sort of wildly unusual. If you look at the debt side, you also come to perhaps a stronger conclusion that, you know, March and April 2020 certainly looked like big drawdown months in terms of the contributions, capital calls into that, you know, the following couple of months, May and June, returning like more to normal figures. In terms of real assets, same sort of story. It was mainly March was the big drawdown month, and again, rather muted distributions, as probably you'd expect over this period. There's a bigger difference there on the real asset side in terms of the distribution, so much lower distributions in the first half this year than in the first half last year. So just some final thoughts before I hand it back to Keith. I think that, you know, there has been this significant Q2 bounce for most of the asset classes, as you'd expect, given what's happened to markets, but it isn't a uniform. And indeed, there's some asset classes which are really not bounced at all, like real estate and resources. We don't really see any bounce at all. For the buyouts I think the IRRs and multiples, at least on a median basis, on a fund level basis, haven't yet quite returned to their pre-COVID level, but that may be partly down to lags in reporting. The VC valuations move much less than the buyouts in 2020, and to some extent, some of the funds are clearly reporting figures which are up on over the first half year. As a result of some of these movements, because we've had, you know, we haven't had the big fall and we've had a decent bounce. The PMEs are higher, but they come back in the most recent quarter as the markets have strengthened and the asset values haven't gone up as much. So I think there's clear evidence the returns were smoothed to some extent, which I suppose is in many respects inevitable given the nature of the lagged reporting and the like. So I think that's not a criticism; it's just an observation that there is some smoothing going on here in most of these asset classes. I think Europe bounced less in Q2 than the US in local currency, but actually the euro gained against the dollar, so to some extent that helps if you're looking at it on a global basis. And I look at those cash flow numbers and say they've sort of returned a bit more to more normal levels, certainly for equity. It looks like it was more of a sort of March-April effect, and May and June look much more back to normal levels. And so with that, I'll hand it back to Keith.
All right, thank you, Tim. I think, well, we've actually gotten some questions already, but we're going to hold those until the end. And so I'm going to turn it right over to Luis to walk through his presentation.
Thank you, Keith. Thank you, Tim, for your insights on the recent performance of private capital. In the next few slides, I want to drill into the same kind of questions actually that Tim was talking about. I want to, generally, the analysis I'll do will split between things that can actually be done using the standard analytics that we provide in our universe data, but some of it will use the sort of the full depth of the fund level BMU database that Keith mentioned. So I'd like to start with with a passing comment that I made in the previous webinar when we released the Q1 numbers. So at the time, I mentioned that private capital seemed to have incorporated the returns from the listed markets more rapidly than was normal. So the issue here is something actually that Tim talked about, which is the sort of smoothing of private capital returns. So the idea is that at least the valuations in private capital are subjective, which means they're based, in this case, on comparables, making them backwards looking, and that introduces this sort of like lag and sort of smoothing in how they behave. So what that effectively shows up as is when the equivalent listed markets move, the private market responds kind of more slowly, and in the same quarter only typically responds kind of partially compared to what happened in the full market, where the full response will kind of develop over time. So you can see this actually here fairly clearly. For example, around early 2019, what I've plotted here, by the way, is in gray is the listed equities. In blue, we've got US buyout, and I've just simply compounded the quarterly returns. So what you can see in early 2019 is a big movement in listed equities. But then if you look at the blue line, you can see that there's also a drop, but it's not nearly as large as what happened in the listed markets. However, if you move all the way to the right and you look at the last 2 quarters, you can see that things look a little bit different. In particular, the sort of the movement of the private markets, or buyout in this case, is more significant, although still less than what happened in the listed markets. So probably a better way to look at this actually is in the form of a scatter plot. So here, this is the last decade of returns. Vertical axis are buyout returns, horizontal axis are listed equity returns. And what you can see is with the exception of the last 2 quarters, the sort of the line of best fit, or the regression line, is which is shown in blue, has a slope of about 1/3. So what that's saying is that at least in the same quarter, private or buyout funds tend to incorporate about 1/3 of the return in listed markets. Now, moving to the Q1 return, which is in the bottom left in red, as you can see, it's way off the blue line. So in fact, if you wanted to make the blue line pass through the red dot, you'd have to increase its slope significantly, which is just another way of saying that you'd have to increase the responsiveness of the private markets to what happened in the listed markets. So that's kind of a visual way of sort of displaying the comment that I made last time. I'd also mention that if you look at the Q2 return, which is in the upper right in bluish green, you can see that's actually much more in line with that blue line, although probably if you wanted the blue line to pass through it, again, the slope would have to increase a little bit. So before I leave the slide, just 2 final comments. So one is, why was the Q1 return so different? So I propose that there's 2 things at least that may be going on. So one is a volatility effect. In other words, when markets are volatile, as they were towards the end of Q1, essentially everything happens faster, and that may well include the incorporation of the effects of listed markets into private equity. The second effect is that this is the kind of crisis or event that we went through or are still going through. So generally speaking, in say a recession, there's a certain lag until it's clear that you are truly in a recession. So it may take some time, particularly for private markets, to sort of adapt to that. In contrast, in March, within a matter of a few weeks, it was completely clear that we were in some kind of crisis. So that may have sort of accelerated the incorporation of the effect into private markets. So next, I want to talk about the dispersion of returns. So what I'm going to plot here is, again, I'm going to be using quarterly returns for funds. In contrast to the previous slide where I was pooling the numbers, here I'm directly looking at the individual fund returns and I'm plotting the median in red, and then the bars are the intra-quartile range, the 75th return minus the 25th percentile return. So I'm using that as a measure of dispersion, and in turn, I'm thinking of dispersion as a measure of perhaps uncertainty in the valuations at the end of the respective quarter, or perhaps also a measure of the heterogeneity within the asset class. So looking at the slide and starting with real assets and debt, what you can see is that there was a clear increase on the right-hand side in the dispersion in Q1 and Q2. It's higher in Q1, so it seems like in Q2 things settled down somewhat. Now, of course, comparing all the way on the left with what happened in these two asset classes during the GFC, clearly the events are not as dramatic now, but I suppose that's not surprising given that the GFC was a credit and a real estate crisis. Moving to the top row, which are equity funds, again, you can see that there was an increase in the dispersion of returns in Q1 and Q2 on the right-hand side. It's not as noticeable as in debt and real assets. Part of it happens to be that the increase in dispersion is obscured by the previous quarter, which is the 2019 Q4. And in fact, I've shown all the Q4 dispersions in a darker shade of gray to highlight the fact that in general, what we see is larger dispersion in Q4, particularly in equity and real assets. In other words, what's happening is that there are more funds updating their valuations and updating to a greater degree, leading to a sort of greater amount of dispersion in those quarters in Q4. So in any case, in the case of equity, that sort of hides a little bit the increase in dispersion. But in any case, it's actually easier to see what's going on if we drill down into the next level in our asset class taxonomy. So here, maybe I'll start with the top row, which are the three largest subclasses of the equity asset class. So here you can see, I think, a pattern in the dispersion that seems at least reasonable to me, in that the largest increases in dispersion are in expansion and in venture capital, and then buyout was more muted. And I think that's probably in line with the idea that the recovery in Q2 is based on sort of expectations about how the economy will recover and what changes may sort of stick. Obviously, expansion and particularly venture capital are particularly sensitive to these future expectations, which are nevertheless uncertain, leading to this increase in dispersion. Then next, moving to the bottom row, which are the sub-asset classes or the largest sub-asset classes of real assets. I think the interesting one is on the left, which is the response of real estate, which I would say is a little bit surprising in that both in the median numbers and the dispersion are probably sort of more muted than I would have expected, given that it's real estate. But in any case, for me, the most interesting asset class here is debt, which is the middle row. So on the right-hand side is distressed debt funds. So here there was a very large increase in dispersion. I think for distressed debt funds, that's not particularly surprising. But I think what is interesting is on the left, which are the senior debt funds. You can see that there's also a very notable increase in dispersion. In fact, it's probably a larger increase in dispersion even than in mezzanine funds. So at least for me, this is particularly surprising, especially given how non-disperse the returns of senior debt funds have been in recent history. So to dig into that a little bit, let's actually look at the actual returns of senior debt funds in the last 2 quarters in the form of scatter plot. Horizontal axis is the Q1 return, vertical axis is the Q2 return. And I think what you can see is that probably that increase in dispersion is driven by a number of extraordinary returns that we can see in this scatter plot. So for example, there's quite a few funds with returns below negative 20% in Q1, and then several funds with returns above positive 20% in Q2. And we think that what's going on here, and why at least initially it was a little bit surprising, is that it's a leverage effect. Namely, the senior debt funds are using or commonly use leverage, and that can lead to these kind of returns given the kind of dislocations that occurred in the credit markets. The other thing I'd point out about this graph is that the funds that performed poorly or fell the most in Q1, it's not random which ones then bounced back the most in Q2. In other words, loosely speaking, the data seems to be concentrated in the second quadrant, the top left quadrant. So this idea is something that I'll return to actually in 2 slides. So before I leave the idea of the dispersion of returns, I just wanted to show not just the interquartile range, but actually the full sort of distribution or histogram of returns for the major asset classes. So here, what I did is I started with 2019 Q4, which was a relatively normal quarter. As you can see, the one interesting feature of the individual fund returns here is that the returns are skewed. This is particularly clear in the case of equity funds. And this actually touches on something that Tim was talking about when he was saying that the skewness in the returns, as well as perhaps how it interacts with fund size, leads to differences between things like medians and pooled returns. So in fact, the red vertical line is the pooled return. I haven't plotted the median, but you can sort of more or less intuit that it's usually fairly close to the mode, the sort of the hump of the graph. So in particular, again, looking at equity, you can see that it's got a very strong positive skew, as indicated by the fact that the red line is kind of way off to the right. Then moving on to the middle row, which is Q1 of this year, you can see there was a remarkable shift in the shape of the distributions, or the densities, the histograms, where before they used to be positively skewed, now they've almost mirror reversed and become negatively skewed. Again, you can see that very clearly by looking at the position of the red line relative to the mode of the density plot, which in this case, the red line is kind of way off to the left. And then finally, moving on to Q2, we see a reversion back to the sort of the normal state of affairs, which is that there's this positive skew. Now we see both in Q1 and Q2, the skewness was very clear across all 3 asset classes. In addition, in Q2, I'd say that there's sort of some more, what you could say is kind of bumpiness or heterogeneity, or perhaps multimodality or something going on in the distributions in Q2. But in any case, there was this sort of massive switch as it sort of went from positive skew to negative skew back to positive skew. And in fact, that kind of flip-flopping or mirror reversing might lead you to wonder whether the funds that are, were way off on the left-hand tail in Q1 became the funds that were in the right-hand tail in Q2, which essentially is the same point that I made back one slide with regard to senior debt. In other words, is it the case that funds that fell the most in Q1 tend to be the funds that recovered most strongly in Q2? So the most obvious way of examining that question is to, in fact, draw a scatter plot just like we did with senior debt. So here I've done exactly that. And in fact, looking at this, I would say that, well, first, what are our expectations? If in fact the world was laughably simple and in fact literally the funds that without exception that fell the most then sort of bounced back the most strongly, then you'd expect a tidy negative sloping line of some sort. Now this is private capital data, so of course that's never going to happen. The data is quite noisy. Nevertheless, if you look at least at debt and perhaps real assets and squint, I think you can kind of see a sort of downward sloping tendency in those two asset classes. On the other hand, in the case of equity, it's a little bit harder to tell what's going on. At least part of the problem here is just the sheer volume of data. There are many thousands of funds, making it just difficult to truly see what's going on. So the natural thing to do to deal with that is to aggregate the data in some way. So in the case of this kind of data, pooling is the natural thing to do. So the plan of attack then is going to be this. What I'm going to do is I'm going to break up the funds in each asset class into quartiles by performance in each quarter, and then just simply see what happens in the next quarter. So let's actually do that. This is a little bit subtle, so I'm actually going to take it kind of step by step. So what I've done here is, as I said, what I'm doing is I'm dividing funds into quartiles by their performance. So the way these plots are going to work is the vertical axis is going to be, you could think of it as the sort of the current return or the return that's shown in the legend. So in this particular slide, the vertical axis is the 2019 Q3 return. The horizontal axis is just the previous quarter, so 2019 Q2. And then what I've done is I've taken the funds quartile, divided them into quartiles by the return along the horizontal axis, which was 2019 Q2. And then keeping the same groups, just observed what happens when you move on to Q3, and then just kind of plotted the pooled returns of each of those groups along the horizontal and vertical axis. So essentially, what this does is, if there's a certain amount of momentum, or you could say persistence, in the returns of funds from one quarter to the next, then you'd expect an upward sloping graph. What I mean by persistence is not, of course, what Tim has written about in some of his papers. I just mean that if funds that performed relatively well in one quarter tend to perform relatively well in the next quarter, then you tend to get an upward sloping line in this kind of graph. So in fact, looking at this graph, there in fact is a, broadly speaking, almost without exception, the lines are clearly upward sloping. So we do see in sort of normal situations, such as this quarter, we see this kind of tendency where funds that do well in one quarter tend to do well on a relative basis in the next quarter. And then moving on to the next quarter, so now the vertical axis is 2019 Q4, you can see that broadly speaking, the same pattern persists. In other words, broadly speaking, the lines tend to be upward sloping. Now, next, we'll move on to more interesting quarters. So now the vertical axis in red for the red data is 2020 Q1. So given that it's Q1 of this year, the returns were negative. So obviously the red lines moved way down. Given the sort of the chaos of Q1, the data I think is a little bit messier. It's less clear whether they're upward sloping, although, you know, broadly speaking, perhaps they still are upward sloping. Certainly for generalist funds, it's upward sloping. With real assets, with one data point omitted, it's upward sloping. Equity is kind of flat. And in fact, that is sort of interesting here in that aside from the highest performing quartile, it is actually very upward sloping. But the the best quartile in Q4 became literally the worst quartile in Q1. And I think that what's probably happening there again is that there's a leverage story sort of playing a role. In any case, the most interesting quarter is the most recent quarter. So in black, what I've plotted is, again, the vertical axis is the most recent return, 2020 Q2. And again, as always, the horizontal axis is just the previous quarter. So here we see a dramatic change in the slope of these lines. In other words, while they were previously more or less always upward sloping, now there's a very clear downward sloping shape or to these lines. So what that says is that in fact that hypothesis we had, which is that on average funds that performed the worst in Q1 are the funds that on average performed the best or performed better relatively well in Q2. So finally, and I think I'm probably running out of time here, I wanted to talk a little bit about cash flows, just like Tim did at the end of his slides. One nice thing about cash flows is that they are not dependent on valuations. So what that does is it allows us to show much more recent data than we can show when we're talking about performance. So in fact, in this slide, I have data that is current as of a few days. So what I've done is I've grouped the cash flows by week. In fact, the labels for the weeks are at the bottom and they're tiny. So given that they're almost impossible to read, I've also divided the chart into Q1, Q2, and Q3 using dashed lines. And then what I've plotted on the vertical axis is a kind of a normalized cash flow for the particular kind of fund. So what I've done is I've just normalized by the total active capitalization of funds. So that means funds that have not liquidated at that point in time. Bear in mind that funds take a long time to fully liquidate, so the denominator is probably larger than you might expect, which makes the vertical axis, at least its absolute values, a little bit hard to interpret. But what is meaningful is their relative value relative to sort of recent cash flows. So what I've done in view of that is in red, I've plotted the 2020 cash flows, and then in gray, I just averaged the previous 5 years of cash flows for comparison with the red bars. And then the top row are contributions, bottom row are distributions. So maybe very quickly, just to wrap up here, I'd say that in the case of debt, the picture on the contribution and distribution side is pretty similar. They're both a little bit behind where they used to be in relative to historical levels. I think equity is a little bit more interesting. As Tim said, on the contribution side particularly, there's been a sort of recovery. So particularly by the time you get to Q3, you can see that contribution cash flows are very similar to historical levels. On the other hand, looking at distributions, it's a little bit different. I feel that it looked like they were recovering in Q2. Oddly enough, in Q3, it almost seems that they were slightly behind relative to Q2, with the exception of the last few weeks where perhaps there's been an uptick. So it remains to be seen what happens in Q3. And then very quickly, in the case of real assets, I would say both contributions and distributions are behind historical levels, but especially on the distribution side. So that probably could lead to some imbalances between contributions and distributions. So I think with that, I will hand it back to Keith.
All right. Thank you, Luis. Let me share my screen. All right, so let us now move into the Q&A portion of our webinar. So a few questions have come in so far. For everyone else, please feel free to use the form. It should be right in the GoToMeeting screen that you're on. You should be able to ask questions. Now, in terms of kind of an opening question, we started, I think, last webinar with a question of whether was there anything or what was the most unintuitive part of the returns for Q2, and I'll direct that to both of you, perhaps to you first, Tim.
I mean, for me, I still want to understand what's going on in venture capital, because some of those figures that we saw were a big bounce in terms of the first slide I showed, which showed the quarterly returns. I think at about, for the US funds about 12%, having gone down only about 3%. So I really would like to understand that and the extent to which that's actually being driven by a few funds and maybe the larger funds. So that was the thing that made me stop and take notice the most, trying to think, how does that relate to the fund figures, which don't, with the overall fund figures, the median fund return figures, which don't really show that at all. That sort of almost like a 3 times as much bounce as there was negative to begin with. So that's the one that I would pick out.
And at least from my part, I'd say there's maybe 3 things that I'd mention. So 2 of them I actually mentioned in my slides. One is how rapidly private markets responded in this case, particularly in Q1, but to some degree in Q2. Second would be the kind of a couple of asset classes had a little bit surprising in terms of median dispersion. So the 2 I'd point out there, of course, are real estate and senior debt, although I think senior debt we understand a little bit better now. And then the final is something that I think if I'd had a bit more time, I probably would have included a slide on it. It's actually something that Tim talked about, which is what we've seen in terms of a size effect. In other words, to what degree did large funds behave differently from small funds? And again, and actually this is something we touched on in our previous webinar regarding whether large funds, for example, use more fund debt, particularly subscription lines of credit. And with that in mind, perhaps it's maybe not exactly surprising, but at least interesting that we did see an effect where large funds were had particularly negative returns in Q1 and then recovered a bit more strongly in Q2.
All right, thank you both. Maybe continuing on the topic of beta a little bit, this was kind of an interesting slide here. Now, should this just be thought of an outlier quarter? Or should the beta line have a kink in it? I mean, this is a pretty unintuitive, or not unintuitive, but a surprising result here.
So, so I think it's an interesting question how to interpret this. One thing that I could say is that, so this is the last decade of data. So an obvious question is, if you just added a bit more data back to the GFC, what would it look like? And it turns out that there were, well, first the GFC was a bit more prolonged than at least what we've seen so far, but some of the most negative returns were similar to what we see in red, namely the Q1 return here. In other words, they were outliers. They were the private markets reacted more rapidly, it seems, than expected. On the other hand, I feel that the problem.
Louise, I think we're losing you a little bit. You broke up a little bit. Not sure if it's your internet or your headphones, but might want to restart those headphones. And then you have Bluetooth. So maybe let's go over to Tim. The cash flow, the debt slide here, this was a pretty interesting slide. Now, it seems to be clear evidence of seasonality. You referenced that this was something you hadn't even really been tuned in on yourself. I mean, is this an area that requires more research, and are there real applications here in kind of portfolio management and cash management?
I think there are, and I certainly, it's the more I delve into your data, I always find a few nuggets like this that I had really no idea about. I think though there are quite a few people out there who do this sort of cash flow forecasting, aren't they? And I know that they do it according to the sort of nature of the fund and the normal drawdowns that you see and the distributions. And I guess they probably got this seasonal pattern built into them as well. I don't know. I haven't really looked carefully at those models, but I know there are people who spend their whole lives really, trying to come up with good cash flow models for asset owners. And I guess they know about this. But certainly to me, this was new, and maybe shows that you could do, if you had this sort of granularity of data, maybe you could come up with your own model, not too without too much difficulty. Of course, we're only seeing 2 years here, so you have to be a bit careful. It might be that all other years there isn't this sort of Christmas effect where it seems like Christmas you get asked for money. It's a bit like being a parent. It's not really like being a child. You get asked for money net, rather than getting it.
All
So
right.
Keith,
Okay.
are my headphones back in operation?
Yep, you're good. So you want to expand upon his points?
I was just going to make one quick point to follow up from Tim's points, which is that one interesting thing that we saw when we talked about it a quarter ago, and I think we've seen a little bit more here, is the sort of question of whether to what degree you can predict something about the cash flows based on sort of listed market effects. And I guess my only comment was simply this, that one thing that we very clearly saw, and it's kind of what I was touching on with leverage in senior debt funds, is that you may get, and you can perhaps predict a certain amount of capital calls by funds that are levered and suddenly find themselves in desperate need of all the capital they can get their hands on. So, perhaps that could be something that some kind of model could incorporate.
Okay. I'm keeping with our little bit of a discussion on seasonality here. One of the viewers got a little tuned into what appears to be kind of a spike in, obviously, the dispersion increases in the fourth quarter, but then also just seemingly the quarterly returns may have a seasonality there. So is this seasonality seems to extend into returns as well?
Mm-hmm. It does. And I think, part of what's going on here is that you just see let's say the typically positive returns of the markets get incorporated somewhat more slowly across the board. And then, as best as we can tell, the quantitative way of saying that is that Q4 just incorporates more of that return or more rapidly than usual. So it's kind of like if you think of that sort of lagging and smoothing that Tim mentioned, you could say that it sort of gets compressed a little bit in Q4, and that in turn tends to sort of produce a slightly higher return on average in Q4.
Yeah, this is actually being found in some academic research. We some work I've done with Rudy Stucker and Miguel Souza showed that we call it the Santa Claus effect, and we put it down to auditing potentially of the most of the Q4 numbers are audited, and so you might roll things forward for a while and then do a better job of updating it in Q4. But it's quite clearly there in the data. There's a positive Q4 effect on valuations, I think.
Definitely.
Okay. Thank you both. Now I'm going to go back to this set of slides here. I'll go to, I suppose, the last one, because there was, I think, 2 clarifying questions. Could you just walk through, at least maybe again briefly, the quartiling here? So I guess we're taking, based upon the previous quarter, we split the funds into 4 buckets, and then we see how those buckets behave in the next quarter. Is that the right interpretation?
Exactly. So just for the sake of argument, let's look at the black line. So what I did there is the horizontal axis is the previous quarter, which means in this case Q1 of this year. The vertical axis is the, in a sense, current quarter, which is Q2 of this year. And then what I've done is I go to Q1, I just look at the returns of, let's say, the equity funds, divide them into quartiles, and then just compute the pooled returns of those quartiles. That becomes the values on the x-axis. Then, keeping the same grouping, I just move forward to 1 quarter in the future, namely Q2, and just see what happens in Q2. And that becomes the numbers on the vertical axis. Okay. And again, the interpretation, if you leave aside the sort of the wonkish, technicalities of creating the plot, I would say the takeaway is just that upward sloping means that funds that do relatively well in 1 quarter tend to do relatively well in the next quarter, a kind of momentum of sorts. And then a downward sloping is this sort of like opposite behavior, which is that the harder they fell, the stronger they bounced.
Okay, thank you for walking us through that again. So let me go all the way back to the very beginning of the presentation, because this is perhaps one of the more kind of interesting slides here. So some interesting geography effects, interesting some asset class effects. I mean, we have one of our viewers is kind of really tuned into those venture capital returns. I mean, particularly in Asia. Is this should all the money go into Asian venture capital? How do you interpret this slide from a portfolio management standpoint? Perhaps is it are these some interesting quarters, or is this the beginning of a trend?
Yeah, now you have to be a little bit careful here, clearly, because there are currency effects in here which can be pretty big as well, and so of course they're real if you're a dollar investor, and these may not be all the funds that are reported. So if you have a few funds that have updated their Q2 numbers, and they've done very, very well, then they will be the ones who are included in this data. So I would say keep an eye on this. Maybe don't jump and put all your money into Asia. Don't put here's my advice. Don't put your money, or never put your money all into anything. Spread it around, and keep an eye on that at those Asian numbers, because they are sort of interesting in terms of those returns. But I think my suspicion is, again, making a prediction, is that may be a little bit down to lagged reporting. That when we get to see the full final numbers for 2020 Q2, my strong suspicion is it would be really remarkable if those were the final numbers. In which case, we should really dig down deep into them and see what's going on.
We will have to make sure we dig into those. So maybe as a final question, last time we had ended with just some predictions about the future, maybe thinking further than just the next quarter. What might we expect in the next few years in the different regions, different asset classes, and just private capital in general? And Tim, I'll direct it to you first.
I think that's really a really tough question. I mean, all I would say is that I think that there's still, all the evidence seems to be there's an increasing appetite for investing in private capital, notwithstanding, some interesting debates about performance. But I think that all the evidence is that investors are still wanting to move in this direction, and think that there is alpha there. So I do see the capital flows still coming in, and of course there's a lot of dry powder. So these are sectors which are not going away. I interpret it that the exposure, especially on the tech side, that some of the exposures that you're getting to private assets on the venture capital side are actually very valuable. And so I suspect people are going to get more interested in the VC asset class, probably a little bit more worried about real estate in general, both private and public. Although, of course, when a sector gets bombed out, it's often a good time to invest. But I suspect we're going to see, my strongest prediction, I think, would be that we're going to see more movement into VC. And more buyout funds, or people who were buyout funds calling themselves, growth capital funds or something like that, and starting to drift into VC, which is of course a complete reversal of where we were 20 years ago, where most VC funds became buyout funds. I can see a lot more buyout funds starting to become a bit more like VC funds.
Okay.
And
Luis?
For my part, maybe I'll make a slightly more cautious prediction, which is more something that I'd be interested to see whether the perspective on fund debt will change over the next couple of years. Obviously, we talked about what happened with debt funds or senior debt funds. That was almost certainly NAV debt, or at least sort of to some degree NAV, mostly NAV debt. In our previous webinar, we spoke about subscription lines of credit, but they both end up having the property of potentially generating very large capital calls at precisely the time when it's most awkward for LPs. So I would be interested to see whether there's a sort of reevaluation of the use of fund debt.
Okay, well, thank you both for both of those comments, and that is actually going to bring us to the close of today's webinar. So thank you to the audience, and thank you to Tim and Louise for joining us. Now, both of them are quite the researchers, and so if you see the links up on your screen now, you can you can follow these for more information about either of them. So thank you again for joining us, and have a good rest of your day.
Thank you.